The trading systems detailed on this course have already undergone a fair amount of stress testing. They've been tested across different market conditions. They've been tested on out-of-sample data, and they've been tested with different start dates and transaction costs. My own view is that stress testing can always be added to. So in this lecture, I'm going to go through some of the techniques that can be used to stress test a trading system further. After all, the ultimate stress test to a trading system is when it's committed to the live market, and at that point, it's real money that is on the line. I always try my best to break a trading system, find out its flaws and weaknesses, and if I can't break it, then I know that I've got something useful. So the first thing is to always use out-of-sample data for validation. Always use unseen data to run the system on to see how it performs. At the end of the day, you're just trying to create an environment that is as realistic as possible with which to prove the system before you take it live. And this is also why paper trading, demo trading is a good idea. Second, we can run walk-forward analysis, which is simply a way of training a system on in-sample data and then moving forward into the out-of-sample data. This can be done in sequences so as to mimic how we might build a trading system and then how we might trade it in real life. This works well when you have parameters in the system you want to optimize. Financial data is always moving, so this is the best method for keeping a system in tune with current market conditions. Third, test different market conditions. As I've mentioned before, we can run the system on data that includes different market regimes. If we only test the system during a bull market, we won't know how it performs when the market's going down. Alongside that, we can test the system on different stock universes, different watch lists, even different stock markets in different countries. The idea is to try things that give us more information on the strengths and weaknesses of the system itself. Fourth, similar to that idea, is to try different start dates. If we start on different dates, we might end up with completely different portfolios, so we need to test different start dates to make sure that isn't a significant factor. For example, if we were to start a medium-term portfolio system that trades on daily new highs on the 1st of January, we're going to get a different basket of stocks than if we started that system on the 1st of February. Fifth, transaction costs. As I've said a number of times, financial markets are not stationary. The data changes, and so trading systems need to be robust to those changes. You can stress test a trading system by increasing transaction costs and slippage and seeing how it does. A good trading system should not be too sensitive to transaction costs because slippage can increase during volatile markets. Likewise, you can stress test the system by changing the liquidity rules, such as the volume filter and the minimum price threshold, and then seeing how it gets on. Sixth, Monte Carlo tests. Monte Carlo tests can be set up in a number of ways. Firstly, by altering the sequence of trades to see whether the order of trades had a significant impact on your end result and your equity curve. Second, Monte Carlo could be used to randomize indicator signals or add random noise to the price data itself. By adding noise or randomization, we can better analyze whether the system is robust or not. A good example of this occurs in optimization. If you optimize a moving average and you find that the 20-period moving average works extremely well, for example, but the 18, 19, 21 and 22, the neighboring values, they don't work as well, or even if they work poorly, then there's a very good chance that the 20-period result that you found first was just a fluke result. Lastly, you can run system-dependent tests. At the end of the day, there are probably many more ways to validate a trading system, and it often depends on the type of system and what it's trying to do in the market. Try and break the system. Try and make the test environment as realistic as possible and keep monitoring it when it goes live to make sure it's performing as expected. Observe measures like the out-of-sample error, the win rate, the profit factor, the maximum drawdown, and the longest number of losing trades in a row. Compare these statistics to the in-sample data and you'll be able to get an idea if the system is performing as it should.